Oh, another Buffett video? Will AK ever stop with these? No, never, because I got a buffet of Buffetts. And boomer funds get boomer returns. Look at this Berkshire stock, so sad. I mean, Buffett, where's the crash, huh? You were talking about it. Got all scared, sold your airlines. But all I see is the stock market near new highs. Stocks never stop. You can't stop stocks because stopping stocks would be stupid. Stocks only go up, clearly. So if we go through our boomer all-star team of fund managers, Buffett, clearly wrong. I mean, what, you sold airlines thinking people weren't gonna fly? A lot of people I know are flying already. CCPV second wave, who cares? Back to flying and hopefully not dying. And then we got Carl Icahn just blown away by Hertz. How? But wait. Yeah, Carl, bankruptcy doesn't mean it's a bad stock. It means it's a good stock that you should buy that's about to go up 800%, that's about to issue more shares. But thankfully, it looks like the day that I released that Hertz video, the SEC stepped in and said, no, you can't issue shares, you scammers. Was it because of the Fallible YouTube channel? Well, of course. Carl watches it too. This is actually his watching face. This is how he feels when he watches AK Fallible. I mean, what did these guys think? These old timers, did they think that the market works off logic? No. Stocks only work one way. You print more money so that you have more money. It's very simple. There's one boomer that gets it, our pal Jay Powell. Look at him, looking great, feeling great, understands basic math, print more money, have more money. So obvious. I don't know what we've been doing all this time. But there's one more billionaire fund manager boomer who was wrong about all of this. And he's actually my favorite because he is the most fallible. And that's who we're going to talk about today, Buffett's friend, or colleague at the least. But first, as always, if you're looking to up your strategy in the market and make sure that you continue to make money even when the market is going down, then check out our free training. Link in this video and down below in the description and comments. I go through the strategy that I use and what most of our fallible people use as well. And second, before we get started, if you're a millennial and you're enjoying these ageist comments I'm making against these beautiful boomers, then you are a bad person. And just for you, I got some Gen Z TikTok comments to put you in your place. Here's how they feel about millennials. No one. Millennials. Oh, I'm such a Hufflepuff. They're worried about their Harry Potter house, but they live in a 1-bedroom apartment. Y'all are worried about the wrong houses. Do you feel the pain as you get made fun of for those stupid Facebook quizzes you took to figure out what house you were in? No such thing as a sorting hat, just a normal hat. We all know Harry Potter is a touchy subject for millennials, and they say things like doggo, or they're happy that BuzzFeed knows their favorite wine. I'm just gonna drink my coffee, blah. Millennials still say adulting. Millennials be like, yikes, I'm adulting right now. I need to go get avocado toast. All they do is drink wine, post cringy 90s kids memes, and talk about tech startups and lie. As you can see, Gen Z pretty much nailed it, and I hope you feel attacked for the rest of the day. Just so you know, ageism is bad, and you need to respect your elders. Like this beautiful, beautiful man right here. I don't know what it is about him, but maybe it's his soft eyes and just how it mixes with that intense smoldering look that you see here. But man, I absolutely love this legendary market wizard, billionaire, hedge fund manager, Stan Druckenmiller. And Druck has been doing his speaking rounds during this historic time. He was at the New York Economic Club, then he jumped on CNBC a month later. So when he was at the club back in May, when we were about in the middle of this crazy rebound, he was saying that the risk reward for equity was as bad as he's ever seen it in his career. Basically saying stocks are super overvalued, meaning it doesn't make sense for stocks to keep going up. But the wild card that he said back then was the Fed stepping up with their asset purchases. And this is back in May, so he was worried that the government's stimulus programs wouldn't be enough to solve the economic problems that arose from the CCPV and those sweeping lockdowns we had to curb the spread of the disease. Now, Drug knew what everyone was thinking. The consensus out there seemed to be, don't worry, the Fed has your back. In Powell we trust. But he said there's only one problem with that. Our analysis says it's not true, which is shocking because Druck is the guy who says, don't fight the Fed. That's his tagline, and we'll talk about that in a second. But he went on to say that the markets seem too high considering the uncertainty of the environment and the likely bankruptcies looming on the horizon. And that's the same thing everyone was thinking, right? Businesses can't pay off their loans, and what happens? They have to go bankrupt, and then that triggers the domino effect. He said, I pray I'm wrong on this, but I just think that the V out is a fantasy, as in the V recovery. Now, the momentum that he saw thus far in May came from the Federal Reserve when they unleashed all the stimulus, trillions of dollars of stimulus, but that won't help the economy recover, is what Druckenmiller was saying. It was basically a combination of transfer payments to individuals, basically paying them more not to work than to work. And in addition to that, it was a bunch of payments to zombie companies to keep them alive. So yeah, what do we know happened when all this money came through? It went straight into the stock market. I bet Druck wasn't thinking that would happen. And yeah, the whole zombie company thing, that's what happened. They're getting bailed out left and right so that they get to keep going and doing the stupid things that they love to do. And back in May, there was all the hype about the cures coming through, the vaccines, but he said, I don't see why anybody would change their behavior because there's a viral drug out there. Well, Druck, little did you know that people wouldn't even wait for the viral drug. Everybody is out right now getting infected. So that was in May when he spoke at the Economic Club, and then a month later he came on CNBC, and the first thing he said is, I've been humbled many times in my career and I'm sure I'll be humbled many times in the future. And the last 3 weeks certainly fits that category. He admitted that he's only up 3% relative to the market's 40% rally. So basically he missed the whole run because he was too bearish. So Druck is a macro guy, so of course he thought that there was too much debt built up in the corporate sector, and he thought this whole COVID shutdown thing would be the catalyst for the corporate debt bubble to unwind. And that goes into everything we talked about the long-term debt cycle. This is part of that. Corporate debt goes into that equation. And I was explaining that every professional, Druck, everybody thought that this was it. Like, this was the trigger. This is when the big depression is going to start. This is when all the unwind happens. There's no way to kick the bucket down the road. But as we've seen, clearly it looks like the bucket is being kicked. So the Fed's unprecedented actions of buying investment grade and high yield debt to shore up the credit market went against Druckenmiller's thesis of the corporate debt bubble popping. Again, this guy went above and beyond. Even Druck, who loves watching the Fed, couldn't predict it. Like Druck said, I underestimated how many red lines they would cross and how far the Fed would go. He also mentioned that Amazon and Microsoft are his largest holdings. But he said, don't get your viewers too excited on that because I could change my mind in a week or two. And that's what I love about Druck, that last line. And this whole thing, him coming out and saying he was completely wrong. The guy is fallible. And I just got an email today asking me, why would you name your channel Fallible? I mean, doesn't that mean you're just going to make a bunch of mistakes? And the answer is yes, because that's all investing is. You make a ton of mistakes and then you change until you're right and you make money. So even Druck here, like I said, he's the guy who says don't fight the Fed. We wrote a whole article about it. Here's his quote that we use all the time. Earnings don't move the overall market. It's the Federal Reserve Board. Focus on the central banks and focus on the movement of liquidity. Most people in the market are looking for earnings and conventional measures, but it's liquidity that moves markets. See, this is the same thing that we've been talking about that all the Robinhood investors picked up on intuitively. That's why they were able to ride this trend up. It's because they believed in Powell and they believed in the power of the Fed to prop these markets up. They're buying banks, airlines, all these companies that all these professional investors were getting out of because they knew there's no way that this Fed is going to let anything fail. Now, is that right for the long term? No. But is it right for the short to intermediate term? Yes. And in that interview with CNBC, Druck actually said that. He's like, I'm 67 years old right now. Do I think the long term is still going to be bad? Yes, absolutely. But over the next 5 years, the intermediate term, that's what I need to be focused on. Who knows if I'll even make it another 5 years? So he's like, let me focus on what's in front of me right now and play that, which is exactly what the Robinhooders did. And this concept of playing what is versus what will be is very difficult for guys to do in the professional space, especially the macro space. And this is what I think Alex does a good job of at our research firm Macro Ops, because he's able to go into that long-term picture, right? Saying, hey, things do look bad. This is the end of the long-term debt cycle. This might not work out that well. We got problems in China, et cetera, et cetera. But he's also able to zoom in on the present, like the intermediate trend, and say, hey, stocks are going up. You need to be long right now. What happens to most macro guys is that long-term picture just completely clouds the short term. So when everyone thought this was it, this was the popping of the credit bubble, they thought that because they're so biased, they're so bearish, Most macro guys are just fully bearish. Have you ever seen Real Vision? You remember I had a show on there? Well, every single person that comes on Real Vision is super bearish. Raw Paul is bearish all the time. He's having a heck of a time right now that we actually had, this big market crash. But it's like a curse of knowledge. You know too much about the economy and all you see is bad things happening. And then you discount what's happening right now and you don't play it right, because markets and investing, a lot of it is about timing too. Now in Buffett's case, right, he would smack you if you were talking about timing because he's a value guy. So it's still timing, but his is super, super long term. So he would say, hey, invest in the best companies you could find and sit there with them. Now that does work for a value strategy, but very few people can do a value strategy. Most of us don't want to be sitting in dead money for years at a time. I know I don't. So you got to be able to balance that in your head. Like, hey, things might not make sense and things might be really bad, but hey, I could still play this price action, still play what's in front of me. And Druck went away from that. He went away from that and he went away from trusting the Fed to do whatever it takes. But the reason I love him so much is because he's fallible. He's able to change his mind, which is exactly what he's going to do. Even in that last bit of the interview, he's like, hey, I got Amazon and Microsoft, but don't get excited because I might sell them in a few weeks. Who knows? And I love his interviews because when you see him speak, you can tell that he is completely secure with himself. And that's not something you see often in these people coming and talking on CNBC. Most of the guys on Wall Street, most of these CEOs, they seem so insecure all the time. Can't admit they're wrong, scared whether they're ever going to be right again. Druck, though, is so confident he could just come out and say like, yep, I screwed up. He's like, yep, I'm the Federal Reserve guy. I got the quote and everything, and I still didn't do it right. But again, markets are all about being wrong and then switching to being right and making money. You guys remember this quote from George Soros, who is Druckenmiller's mentor? They worked together, made billions, broke the Bank of England. He said, it's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong. So what do we know? In the markets, it doesn't matter if you're right or wrong. The only thing that matters is your bottom line. Are you making money? And guys like Soros, Druckenmiller, all the legends in the game, they could have really low hit rates. Like only 30% of their trades actually work out. The rest of the 70%, they're wrong. But what allows them to be so good with such a low hit rate and make so much money is the way they control their risk. Because when they're wrong 70% of the time, they're making sure that they're only losing a little bit relative to what they're about to make on those 30% of trades that work out. And that's how their whole strategy is set up. Because if they're expecting to be wrong all the time and they want to be fallible, take in new information and change based off what's happening, well, you can't blow your stake every time you're wrong, right? Got to make sure you only lose a little bit, save that dry powder so that the few times you're right, you can really pile in and make a ton of money. And that type of risk management strategy fits with the structure of markets. It's not that these guys are idiots, which is why they're getting 70% of their trades wrong. No, they're literal like market geniuses. It's just that that's how markets distribute returns. So just like you can't fight the Fed, you can't fight the market either. Your strategy needs to match with what actually happens in the market, like the structure of markets. Just like if you're an engineer, you can't build something that doesn't follow the rules of physics. It's like Elon Musk going back to first principles. It's how he's able to learn everything and like do everything. So it's like a first principle of the market that you're not going to get evenly distributed returns. So your strategy needs to account for that. So in our strategy that I was telling you guys about that we teach in this training, we do the same thing. We've structured it so that our downside is cut off and our upside is left open. Does every trade work out? No, of course not. But the ones that do work out are allowed to run. So in the type of market that we have right now, it works really well. And with this strategy, we caught that V bottom. Not because we're smarter than Buffett and Icahn and Druckenmiller, but just because this is what the strategy is made to do. And as long as you're executing a strategy that fits with the market so that it has a positive expected value and an edge, you're gonna have some solid long-term returns. But again, I talk more about it in this training. There's a link in this video and down below in the description and comments. And the story about Druckenmiller just being able to come out and say he's wrong, that's why I like him so much. And even Buffett, you know, in every crisis, every decade, they say, oh, Buffett has lost his touch. Happens all the time. It's happening again right now. But does he care? Of course not, because he's just sticking to his strategy, doing what he does best. And he's very secure with it. So you'll see a difference between the upper echelon of finance guys versus your average finance guy. Because your average finance guy is just trying to compare the size of his peepadoo to the next finance guy. The top echelon, they're secure with themselves and keep their peepadoo in their pants. It's a huge difference, and you'll notice it in the way that these guys carry themselves and the way that they act. So make sure you're replicating the upper echelon and not just your middle ground finance people. But yeah, make sure you check out this training. It's free. And if you like this video, make sure you subscribe. I'm definitely, absolutely, for sure gonna make another Buffett video. A buffet of Buffets. That's what keeps me going. All right, subscribe and I'll talk to you in the next video. Stay fallible out there. Bye.